to It's the Economy. Indian banks have been fighting hard for deposits. Deposit growth has been lagging loan growth almost since COVID years. In the latest data, as of July 26th, deposits have been growing at 11% while loans are growing at 15.1%. The fight reached a new high in July when a leading private bank like HDFC Bank announced a 7.4% rate for term deposits of 1 to 3 years. Why is there such a crunch and how can the Reserve Bank resolve it? Separately, the government also has announced some amendments to the Banking Acts which come as a bit of a disappointment because they seem peripheral. How can the government legally make public sector banks more powerful, more equivalent to private banks? For all these questions, I have with me Mr. Harsh Vardhan, the banking expert. Mr. Harsh Vardhan, thank you very much indeed for joining us. Well, first up, the way we understand banking, every time you ask for a loan, the bank actually creates a deposit in your name. So every loan creates its own deposit. Then why is there a gap between loan and deposit growth?
So this is a fairly complicated issue. And, a lot of people are saying, look, because the depositors, people are investing in mutual funds and equity, and that's why that actually is not the reason, because that money still comes, as you are saying, comes back to the banking system, right? So you have to find out where the money leaks from the banking system. And to my mind, there are three main sources. One is increase in currency in circulation, which means the money gets converted into cash and then goes out of the system. So just let me give you some numbers. So between FY22 and FY24, 2 years, in absolute number, credit outstripped deposit by 5.85 trillion, right? 5.85 lakh crore. Now remember, these growth rates can be misleading because the bases are different.
Yeah.
So you have to look at the absolute number, right?
Yes, yes.
Now in the same period, the currency in circulation went by 3.33 trillion.
Okay.
Right.
Okay.
So that explains part of it. It doesn't explain it fully. There are two other reasons to my mind which are a little bit more complicated. One is through the foreign exchange channel, which is that people take money, buy forex, and then the money goes out of the system because they take it overseas. And the third through the government channel, which is, remember, banks also lend significantly to government through buying their bonds. And if the governments don't spend, then that money doesn't come back in the system.
Yes.
So in my view, what has happened in the last couple of years is the number of banks haven't lent enough. Government hasn't borrowed as much as we would have imagined. And secondly, they have not spent it, especially state governments. So all of this creates that delta between the absolute credit growth and the absolute deposit growth. However, from March to July, Latha, it has corrected. So for example, the absolute credit growth is 3.8 trillion, absolute deposit growth is 7 trillion.
Okay.
However, it has happened the wrong way because what has happened is that credit growth has come down quite sharply.
Okay.
From around 20% in March, April, month on month to about 14% now.
Okay.
So I think effectively what has happened is this clamor for deposit and shortage of deposit has put a brake on credit growth.
Okay.
That has essentially what has happened in FY25, the first.
Yeah. So which is not a nice way to bring
credit.
A
nice way. It's not a nice way. See, if you look at the decade of 11 to 20, it was a bad decade for credit. Credit grew at roughly nominal GDP, slightly more than that. If you look at long-term trend, 1960 to 2020, credit growth is 1.4 times nominal GDP growth, which means if nominal GDP grows at 10%, credit should grow at 14%. Yeah. So we seriously undershot that long-term trend.
Okay. Okay.
We were just about picking up after COVID, and now this has happened. So.
Okay. Okay. But Mr. Harsh Vardhan, in your piece to Money Control, you had explained an interesting concept that maybe as a one-time measure, banks should be allowed to raise bonds as deposits.
Not bonds as deposits, as bonds for the purpose of funding.
Funding, okay. Which is, you are distinguishing it from bonds as capital. Banks can issue bonds, but that is as tier 2 capital mostly.
Tier 1 and tier 2, additional tier 1 and additional tier 2. They can also issue infra bonds and green bonds, as a lot of banks are issuing, but they have end-use restrictions. You can only lend it to some. So what I was saying is a stopgap arrangement, as long as this, if you don't want to sacrifice credit growth, then you have to allow bank a one-time window to raise resources from bonds. And which are what I call funding bond. They are neither capital bond nor this green infra bond, but they are purely for the purposes of funding. And you can put conditions on them, limit on how much can be issued, which type of banks can issue, etc., etc. That all can be put. But as a one-time source of funding for banks.
Okay. The big difference would be that those will be listed and traded. and therefore you expect, say, corporates and big funds like maybe even mutual funds to invest in them?
Correct. So what I had said is that you make them long term, so at least 3 to 5 years. Secondly, you may put some minimum rating threshold, let's say AA and above or A plus and above, so that it becomes attractive to institutional investors like mutual fund, but even pension and insurance, which are large capital.
But Mr. Harsh Vardhan, it just occurred to me, do you think these will be at a cheaper rate than what HDFC Bank is now issuing? See, 1 to 3 years is going at 7.4. And if a leading bank like HDFC says, I'm giving you 7.4, other banks will be forced to raise their rates. Do you think this so-called bond kind of funding deposit that you're talking about will be any cheaper?
Yeah, so there are 2 points here, Latha. One is that today, if you look at bonds, 70% of bonds issued in India are NBFCs, plus 70% plus.
Yeah.
Today, a AA bond will go at about 9%, 9.25. My sense is that banks will be issued at a lower rate. But even if they are not, I am making also one more suggestion: exempt them from reserves. Otherwise, it effectively increases their cost. Today, deposits attract reserves, right? Because these are long-term instruments. They don't create any short-term liquidity pressure. There is no reason to ask for liquidity reserves on them. In the last year of their maturity, can include them in NDTL. So if you did that, my view is that they will be competitive with deposits, number one. Number two, look, 80% and or 85% deposit are 1 year or less in the bank. Banks don't have long-term funding.
They don't have long-term funding. Yeah.
So I am asking for a long-term funding. So I think this kind of almost structurally augments liquidity with banks. This is not a short-term fix.
Got it.
A lot of people argued about cutting CRR, but that creates short-term liquidity,
Yeah, there is a buzz for cutting liquid CRR, and many are betting that RBI may cut CRR before it cuts rates. But in the latest policy,
liquidity, I doubt whether banks will use that to create a 3-year, 5-year kind of lending, because it's a short-term liquidity.
Okay, fair enough. Mr. Harsh Vardhan, the one suggestion which you made and which I checked with some former RBI biggies, that if the bank were to go into liquidation, these funding bonds would behave like deposits. They will be treated as deposits, and they will be given first charge, and the capital bonds and all come later on in seniority. Now, this is something the Reserve Bank ex-guys said will be unacceptable to Reserve Bank because the retail depositor is God. Nobody will be given the same status.
Yeah, but bonds don't have deposit insurance protection.
Okay.
Right? Yeah. They can't be redeemed ahead of maturity. All of this can happen with deposits. Okay. So they are not the same as I am saying only in the unlikely event of liquidation. And now remember, if you put a rating threshold, I mean, what's the real possibility of a AA bank going into liquidation?
That's fair. We thought the same thing of 81 bonds, and one bank had to redeem them, remember?
Yeah, but I'm saying, and secondly, you put overall size limit that you can't issue them more than 2% of your closing NDTL and so on. So,
no, fair point. I mean, I'm just saying that these are this is the kind of opposition you can get from the Reserve Bank.
I feel they are distinct from deposits. Yeah, they are distinct from deposits.
Fair enough. They're bonds, they're distinct from deposits, and they will be listed. So that itself is different.
Correct. So there is a secondary market liquidity. Anybody wants to sell, they can, and will be priced. Yeah.
Okay, fair enough. Now, the other issue that I wanted to discuss with you, we may not have too much time. The government announced a list of banking amendments, and for a brief period of half an hour, it raised my hope that they would be very big. But as it turned out, they were only small adjustments, like, you can have 4 nominees per account, and, what is called substantial interest of directors. Will be counted as substantial only if they had 2 crore worth of shares in the bank. They seem minor. What would you suggest? I mean, we didn't get any banking reform in the past 10 years from the government. All that they have attempted is to sell IDBI Bank stake, and even that is taking an inordinately long time. What would your ask be to empower public sector banks in particular?
Yeah, so I'll have 2 big asks. First is to convert them into company law companies, because that downstream has a lot of other benefits, which we can discuss. This has been in the PGNI committee report. Many other committees have recommended that. And the second one I would say is to lift this limit on foreign ownership of public sector bank. And the reason for that is, look, all of these banks have had their stock rally. this is a good time for government to bring down their own share. They can raise a lot of resources, but for that you'll have to create enough depth in the market, so that there are foreign pools that might be interested in buying them. Right now, somebody might comment that FIs are owning less than what they are allowed, but I think it's probably a good idea to just signal that we are welcoming of higher foreign ownership. So I think those two reforms, to my mind, are relatively easy to do. The first one is a bit complicated, the Company Act conversion.
Act. Yeah, but what benefit will bringing it under Companies Act give? Because if you brought the banks away from the takeover of banking undertakings, or what was the Bank Nationalization Act, and bring it under Companies Act, even then the government will be owning whatever 80-90% in those banks, at least as of now, or at least over 70% in about 5 or 6 of them. They will still be subject to CVC and CAG because of the huge government stake. So what benefit?
So I'll give you a very simple example. Today, if a bank has to undergo change of control, it has to go to Parliament. There is no provision of merger and acquisition within the Nationalization Act.
Okay.
So even if government has to do further merger of bank, each of those cases goes to Parliament for ratification.
Okay.
A Companies Act provides a very neat process, as all other companies follow. That's a simple example of how this can help. Secondly, my view is that once it comes under company law and has all company law directives on composition of board, the board functioning, it will improve the governance of these banks, which is one of the reasons why Nayak Committee had actually made that recommendation. So there are actually many benefits.
Okay.
I can understand why the government would not want to do it, or the bureaucracy, because the current act actually privileges the government as a majority owner in serious ways. Way more than Company Act will privilege a private sector owner of a private company.
Okay, like what?
And nobody will want to give up those privileges.
So I think an example, please.
Well, there is a innocuous sounding line in the Nationalization Act which says that the government can formulate schemes. We have seen many examples of schemes, and those then have to be followed by public sector banks as a part of law, as a part of their compliance with the law. Now, this is a very enormous power that the government has, right? We have seen many schemes, right from Jan Dhan to Mudra. I'm not criticizing the schemes, but I'm saying that ability to formulate schemes is a very strong instrument that the government has with respect to these banks.
Oh, right. Well, then that requires a full-scale discussion, because the government will not be willing to give up that kind of power.
Exactly. So what I'm trying to say, I can understand why people in the government will be very reluctant to do so.
But clearly,
if you worry about governance, if you worry about the structure of the sector, then this is a good thing to do.
Absolutely, sir. Out of time, but we should take this discussion up on a later date. After all, the government in the budget also promised some major financial sector reforms, preparing India for, Viksit Bharat in 2047. We should at least begin with introducing governance in public sector banks. So this discussion, sir, for another day. Unfortunately, out of time.
Thank you. Thanks for your time.
Thank you very much for this discussion on what can improve banking and this special scheme for bank deposits. That's it on this edition of It's the Economy.